Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name's Manpreet and welcome to Cut to the Chase. Now, it was a volatile day in financial markets yesterday as both equity and bond markets extended their losses from last week as they reassessed the Fed rate hiking cycle. Now, just to sum up, what were some of the key moves? US equities, of course, extended the fall further from the start of the week, with the S&P 500 down about 3.9% and the Nasdaq down by a much larger amount of close to 4.7%. Now, on the S&P 500, the eye-catching headline, of course, was it closed down more than 20% from its early January peak, which, of course, is the popularly accepted definition of a bear market. But it's interesting that the sell-off itself in equities was quite broad. So within US equities, all major sectors were lower, and US equity losses themselves followed weakness we saw earlier in the day across major Asian and European benchmarks as well. There was also worries across in the cryptocurrency market as well, with at least two major platforms temporarily halting withdrawals, citing extreme market conditions. Now, it wasn't just an equity sell-off, but on the bond markets as well, we saw both short and long-term bond yields rise sharply, with the 10-year rising up to 3.36% and the 2-year not behind. But again, here the key headline was that the yield curve, or in other words, the gap between the 10 and 2-year yield curve yields, did briefly turn negative, which in turn obviously reignited the recession debate. Interestingly enough, gold did fail to offer a safe haven yesterday, falling alongside risk assets, but it was the US dollar which surged, and we saw the DXY index actually move above its mid-May peak. Now, those were, of course, the major market movements, but what, in our view, really drove some of the volatility was a reassessment of the Fed rate hiking cycle. Now, we saw, of course, yesterday several media reports that said the Fed policymakers were considering the possibility of a 75 basis point rate hike at this week's policy meeting, following, of course, what was a high inflation number last week. But markets also moved more broadly to price in a more aggressive rate hiking cycle for the rest of this year, with markets now indicating about a 1 in 3 chance of a 75 basis point rate hike and a likely Fed rate of over 3.5% by year end, which is up sharply from expectations of just 2.77% at the end of last week. Now, what does this mean for investors? The key focus, of course, in our view, is the Fed meeting this week, and we do believe more broadly the path of inflation and how the Fed chooses to react to it remains the main swing factor. Recall that in our last sort of global market outlook, we had laid out 3 possible scenarios. And, the inflation, how inflation evolves specifically, remains the key swing factor that determines whether we continue to stay in our base case scenario, which is one where the Fed tightening ends up being relatively limited as inflation comes off its peak and, of course, helps the economy avoid a recession, or whether risk starts tilting more and more towards the pessimistic scenario, where the Fed is forced to further accelerate policy tightening and potentially pushing the economy to a recession. Now, this week's meeting, of course, is quite key, and we'd argue that a focus on inflation alone would be more negative, while a more balanced focus on both inflation and growth risks would be a little bit more positive. From a financial market point of view, we do believe for now that our preferences, both from a regional sector point of view within equities, do remain relevant. Recall from a equity sector perspective, we favor the energy and financial sectors, both of which we see as consistent with the risk of a tighter Fed hiking cycle, with financials, of course, benefiting more directly from rising yields, and energy potentially offering some protection against a rise in one key driver of inflation. But we would also continue to look for opportunities in Asia-Japan equities, given, as we noted before, Chinese assets offer one route to diversify away from the Fed and US-centric exposure alone. And finally, of course, the rise in bond yields. That higher yields, of course, creating a much more attractive starting point for multi-asset income strategies. So a lot of volatility and a really key Fed meeting to look forward to this week that we'll be, obviously watching quite closely as well. But we'll take a pause there and hoping for calmer markets later today. As always, if you enjoyed this podcast, please don't forget to rate and like it. Thanks for listening and wish you a happy trading day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.